the idea behind memory stocks and this thesis that it was an unmet need in the market, I think was a bit underappreciated.
All right, joining me for this very special edition of ETF Prime will be Dave Mazza, CEO of Roundhill Investments, who is behind the ETF launch of the year. Maybe the ETF launch of the century, the best ETF launch ever, and that's the Roundhill Memory ETF, ticker DRAM, which, listen to this, DRAM launched in early April, and it's already hit nearly $10 billion in assets. $10 billion. And the thing to understand here is this wasn't a situation, where Roundhill brought their own assets to this ETF or where there was some big institutional seed money lined up or anything like that. This has all been organic. This has been true investor demand. And so this should be a fun conversation because you're going to get to hear the inside story behind this launch. You'll hear when the idea for this ETF was first formed. You'll hear Roundhill's thought process as they were bringing this to actual launch day. We'll find out how surprised they are by the initial success of this ETF. And then we'll obviously get into the ETF's holdings and investment case as well. And I should mention that Roundhill overall, they're now up to 51 ETFs, about $21 billion in assets. And they've had a number of other hits, including the Roundhill Magnificent 7 ETF, ticker MAGS, the Roundhill Generative AI and Technology ETF, ticker CHAT. So they are certainly no one-hit wonder. But the ETF of the hour, the ETF of the year is DRAM. And Dave is now joining me from Los Angeles. Dave, it is always great having you on the podcast, but even better under these circumstances.
Yeah, no, I'm happy to join again and look forward to chatting today.
All right, so you heard me set the scene a little bit there, and I want to offer a few more quick details, and then I certainly want to get your reaction. So Roundhill rolled out this memory ETF on April 2nd. This was the first ever memory ETF. Nobody had done this before. And I'll be honest with you, Dave, in hindsight, I may have been asleep at the wheel because at least from my perspective, there just didn't seem to be a lot of buzz around this launch. I'm not saying that in any sort of negative way. It's just when we're getting 4 or 5 new ETFs every single day, this didn't jump off the page to me. But if we fast forward to today, DRAM is now close to $10 billion. And it actually reached that mark faster than the iShares Bitcoin ETF, which that held the record. So Roundhill has now made ETF history. And I'll start by asking you, on a scale from 1 to 10, with 10 being the most surprised, how surprised are you by all of this? I mean, you obviously wouldn't launch this ETF unless you thought it could work, but surely you didn't see this coming, did you?
Most certainly not. We were incredibly bullish on this idea. I think to your point, the idea behind memory stocks and this thesis that it was an unmet need in the market, I think was a bit underappreciated. So we were bullish on it, but I think I'd be lying to you and everyone if I was saying I could have anticipated this much of demand. But it does show that there is, when you create a product that really is truly distinct and differentiated, although most ETFs say they're doing that today, you can find sources of demand that really, in many ways, outstrip your expectations.
So take us behind the scenes at Roundhill. I'd love to hear when the idea for this ETF first came up in a meeting or on a Zoom call, and why you thought it could work, at least to some degree. And then I'd also love to hear when you and Will Hershey, of course, Roundhill's co-founder, when you first fell out of your chairs after seeing the initial demand for this.
Well, I'll start there. It was really kind of day one. We actually launched it the day before a market holiday, Good Friday. And it traded nearly $70 million that day alone. Now, of course, DRAM is one of the most actively traded ETFs in the market. Less than 2 months after launching it. But if we take a step back to sort of how did we get here, we've been buying the memory chip stocks in our generative AI ETF chat for some time. So we've owned Micron in the US, Samsung, SK Hynix, the two big Korean names, and then some of these smaller companies more on the storage side, your SanDisk, your Western Digital. But when we actually began to say, from an active investment case, look into the idea that these names, even though they had begun to run, actually had significant potential because the business model is changing. And there's debate around that, how quickly that will, from a very cyclical business to one with more consistent demand driven by the AI data center build out. We said, is there a means of packaging these securities in a bit of a different way? So we scanned the universe and looked at existing ways to gain exposure to particularly the South Korean stocks, and found them, pretty lacking. And so what that led to is investors sort of trying to proxy this through semiconductor ETFs. And there's many great semiconductor ETFs out there, but these particular companies, they're not going to be in there in a significant weight because their market caps are not as large as your NVIDIAs and AMD and others. Although that's changing, how fast these stocks are moving. But in addition, you don't get any exposure to Samsung and SK Hynix. So how do you get exposure to them? Should you want to? You'd have to use a South Korean ETF. But the problem with that is that even though you get 45-50% of your weight to those names because their market caps are so much greater than others, you end up with a lot of stuff, shares, securities that you don't necessarily want. So you're ending up with a thesis that you're long Korea, although you're going to benefit from being long Samsung and SK Hynix. But so net, existing semiconductor ETFs didn't provide the right exposure. South Korean ETFs didn't. So we saw an opportunity to package these securities in a precise manner. And the precision, I think, is really important here because although memory is now getting on greater people's radar, it's a pretty closed market, right? 3 companies, Micron, Samsung, SK Hynix, control the majority of supply. And so anything further than the 9 securities, and there's some actually potential IPOs coming in the Chinese market that are interesting, gives you a lot of dilution. So we thought precision here was incredibly important, and we applied some of the similar means that we do with our Magnificent 7 ETF MAGs to do so.
You mentioned South Korea ETFs, and if you look at the biggest one in that space, I know earlier in the year there were significant inflows into that product, and I think you hit the nail on the head. If you look at the holdings in that ETF, you had SK Hynix and you had Samsung, so it looked like clearly investors were using that ETF as a proxy to get exposure there. I'm curious, when you saw the significant inflows into that ETF, did that give you some optimism that maybe DRAM could be a more successful product than maybe previously thought?
Yes, I think most certainly by seeing sort of the huge demand in that ETF, our hypothesis, which actually based off of some of the outflows that we're seeing there, are now with the introduction of DRAM, was that was really being used as a proxy. So for exposure, generally, country ETFs are either used in a kind of a strategic or tactical model setting, and you're rotating between countries. Other times, countries become sort of a thematic trade. And I think that's one of the reasons why we saw such strong demand there. But now with the precision that DRAM gives you, I think investors are gravitating toward that.
Before we get into the ETF itself, I know you're not going to give us your entire playbook here, but can you offer at least some insight into how Roundhill approaches product development overall? Because clearly, you're not afraid to try some new things. I think you've already rolled out like 6 ETFs this year after a number of launches last year. I'm just curious, how does the Roundhill team think about idea generation around new products?
We take a very dynamic approach to idea generation, right? And also a mosaic approach where we're using sort of our own insights from what we see in the marketplace today, quantitative research of where you're seeing flows, but that's actually can be a bit backward looking. So while of interest, we don't rely just on the data to tell us, because the art comes from, well, what are we hearing on social media, or what are research reports saying about emerging opportunities, and then generally where do we think the market is going, and then also are there gaps in the market, right? DRAM is really, in one way, it's very simple. It's an exposure tool, and there was a huge gap in that space, which has been filled. And then you throw in sort of all the other bubbling up of ideas that we were seeing, we saw there to be an opportunity. And to your point, more broadly speaking, we have shown an interest and then an aptitude on sort of identifying some of these unmet needs, either through exposures like we do with Magnificent Seven Mags, now with memory and DRAM, thematic equity investing, income investing, now most recently kind of tax-aware exposures. So while a growing ETF issuer, we believe that we want to participate in multiple buckets of the ETF market, because it continues to be, as you know and talk about very frequently, the space has changed, and that dynamicism, I think, allows us to take advantage of where opportunities are and deliver solutions toward investors who want to express those views.
With the DRAM ETF being the perfect example of that. And so let's get into that ETF. And I guess first, you don't need to get too far into the technical weeds here, but do you mind explaining what DRAM is? Not the ETF, but the memory itself, and why it's important in artificial intelligence.
Yes. So DRAM is short for digital random access memory, which is sort of one of the most widely used or well-known terms when talking about memory chips. And there's others like HBM, high bandwidth memory. Then there's a variety of others, but to your point, we don't need to go down every acronym that exists for memory chips. But what really is a memory chip? Maybe we can just start there. It's a specialized type of semiconductor chip, just like a GPU from NVIDIA is a specialized chip, or even CPUs from a company like Intel or AMD. Memory chips are really where information is held. The term, in this case, is quite intuitive. And what's changed about memory chips is they're everywhere. In the technology we're using to speak together, there's a memory chip, there's memory chips in your phone, smart TVs in the car. But in many cases, they were really had historically more consumer-driven demand. So they were kind of prone to these boom and bust cycles, where you'd see overcapacity build or over demand, then capacity built, and prices would then collapse. Over the past few years, the price for actual, and there's markets for this, the price for actually buying these memory chips has increased sharply in ways that has not been seen historically. And why has that occurred? Well, as the actual highest generation chips, the GPUs, become more and more efficient and more powerful, you need more and more memory to make those work. And why do you need that to make them work? Is due to the fact that those chips are incredibly specialized. They're like a head chef. But a head chef can only work as well in their kitchen unless they have the ingredients to be easily pulled from. So the term mise en place kind of could apply here, because your memory is really taking those ingredients very rapidly and frequently. And then these storage chips, which is a subcomponent of memory, I like to think of it as almost the refrigerator or freezer, where you need to access, but not necessarily as frequently. So as we have this big AI data center build out, these projections of CapEx from the hyperscalers that go from 500 billion to 600 billion, 700 billion, a trillion, as quickly as that previous announcement came out, where is that money really going? Well, it's buying, of course, the most expensive chips, but along with that, they're buying memory. And there's also a belief that as we move from just training large language models to getting to the inference phase or agentic AI, you need more and more memory to make that happen, so that information can be recalled in a smarter and quicker fashion than it would be otherwise.
Okay, so that's perfect backdrop. Now let's talk about the ETF itself. And as you mentioned earlier, this offers exposure to companies like SK Hynix and Micron and Samsung. Those three alone make up 75% of the exposure. And then there are companies like SanDisk and Western Digital and some others. I think, 9 or 10 companies in all?
Yeah, there's nine companies in the portfolio today.
Okay, and so maybe talk about how those three main companies, SK Hynix, Micron, and Samsung, that dominate market share for memory and therefore dominate the weighting in the ETFs. Just talk about the role that they're playing here.
Yeah, so I think there's a lot of, when you think about creating ETFs, there's a lot of different approaches that could be taken, right? In some cases, diversification is really important. If we're thinking about getting exposure to the entirety of the US equity market or global securities, international securities, as sort of large beta allocations, you probably want the full spectrum of investments possible. But when it comes to, and at one point, sector ETFs were precise. They took the S&P 500 and sliced it 10, now 11 different ways to gain exposure to the market based off of the underlying sector. Industries took that a step further to kind of provide precise exposure to industries. Thematic ETFs took that even differently, kind of combining better ways to identify a particular company in an industry than just using an industry classification approach. In this particular case, the precision is really important because there's only a handful of companies that actually make these chips to begin with. And so we took a very sort of stringent approach, or I should say the ETF takes a very stringent approach toward ensuring that companies that would make their way into the ETF are gaining the majority of their revenue from memory chips. And with that said, because what they're called the big three, your Samsung, SK Hynix, and Micron, control the vast majority of the underlying market for memory chips, we're giving them sort of the weights that they deserve. And then the other companies that are involved, particularly SanDisk, Seagate, Western Digital in the US, which make a specific type of memory chip storage, they gain the weight that they would, that's reflective of sort of their share of the overall market.
In terms of how you're getting such concentrated exposure within the ETF, in terms of those big three in particular, you are using swaps to help with this because of fund diversification requirements. Do you mind explaining that aspect just for people who are unfamiliar with that?
Yeah, so one of the things that is used in this ETF, similar to a way we use in our Magnificent 7 ETF mags, to gain that precision exposure is, in addition to owning the underlying equity of a particular company, we'll use a total return swap, which is essentially a contract with a investment bank to provide, to gain that additional exposure. So the performance of the fund, we own the exposure through the swap. So the performance of the fund behaves in the same way that it would if it was done entirely through equities. But in order to meet those requirements, we do use both tools to allow that precision to happen.
Along with covering swaps, I always like to do some ETF 101 on here. And I've noticed, given the demand for this ETF, it has traded at premiums at times. I would say a higher than normal premium. And so what should investors know or understand about that? And were there any other operational challenges just given the record demand for DRAM?
Yeah, I think it's interesting. The one, DRAM is unique in the fact that it has a significant exposure to the Korean won. The companies are denominated in that, so investors should understand that they're gaining exposure to two or more than two, but in a large weight, two specific securities that are listed in Korea. But what that means is that, like you see with some international ETFs, you could have higher than normal premium and discounts, particularly compared to an ETF where the underlying securities are open only in US trading hours. So those securities trade overnight, essentially, and the ETF trades during the US market hours. So some of that's to be expected, but to your point, there are times, even with the creation redemption mechanism in an ETF that we've all known and love, where demand, particularly at the early stage of this ETF, was really outpacing the supply. We did see the fund trade at premiums, which may be higher than people would expect when buying an ETF. As the underlying market has developed, additional market makers and many additional market makers are now pricing DRAM because of the demand that has come. We've seen that moderate and get back to levels that you would expect for an ETF. It's never going to be as low as you would see with a US only ETF. But I think what's fascinating and what I love about ETFs is that One, the market tells you very quickly if a fund is going to be in demand or not. That's been a big change from even when I started in ETFs, which feels at this point a long time ago. But it's also, the market is so dynamic. It's interesting. So the CBOE listed options very quickly on DRAM. They also listed weekly options recently. And, even people who don't trade options regularly or have any interest in that, having that options ecosystem on an ETF really helps the underlying trading of the ETF. And so now we have a wide range of investors in DRAM, not just retail investors and RIAs who are some of the early adopters, but we're actually seeing institutional investors and hedge funds use the product in many unique ways through the ecosystem that's been developed very quickly around it.
Yeah, and we're also seeing a small cottage industry of products that are tied to DRAM in registration with the SEC. So all of that kind of contributes to the ecosystem overall. In terms of the underlying markets themselves, let's talk a little bit about performance. And I won't have you comment specifically on performance. I'll just note that since launching, as of the time that we're recording this, the DRAM ETF is up about 75%. And of course, in this space, things can move quickly up or down. But given that's obviously a sizable move over, say, a month and a half, do you have any concerns that the tail is wagging the dog here, that the popularity of your ETF is driving up the demand for these underlying companies, right? Or do you view this as all one and the same? Like, if investors want exposure to these companies, they want exposure, and it doesn't really matter where they get it, whether it's through a Korea ETF direct or through DRAM. I'm just curious, how do you think about those dynamics?
Yeah, I think increasingly ETF issuers should think about that. So these are reasonable questions to ask. What's interesting though is that then you need to kind of pair it. Well, what does the data say, right? If this ETF saw this much demand, and I'll use something a little bit crazy, but I think it's true, in a Peruvian small cap equities, then which don't have liquidity, aren't multi-$100 billion companies like Samsung, SK Hynix, and Micron are, then maybe you'd say, yeah, the introduction of an ETF in that market is impacting the underlying prices, and the tail is wagging the dog. In the case of this space, because although these names are new to some people, they are very, very large companies with very, very diverse shareholder bases. But what DRAM has done is it has unlocked in a better way exposure to Samsung and SK Hynix that wasn't available to everyday U.S. investors. But as we were talking about earlier, they were doing so with a South Korean ETF before then. So I don't think the introduction of DRAM has necessarily made it a tail wagging the dog situation. But it is something that we monitor, particularly knowing that our fund has grown sharply. So understanding the potential impact that our trading activity could have on the underlying securities.
Okay, so with that, then let's talk about the investment case moving forward and maybe what potential performance could look like. And I'm just going to play devil's advocate here, which I think I always like to do. It helps people learn. But look, Dave, I mean, this space seems like it isn't an absolute frenzy right now. You do have some people calling it a bubble. Some people are saying this is all overbaked. And obviously with a caveat that you can't predict the future and nothing here is investment advice, what is the potential bull case moving forward? Why can this space continue to outperform?
Yeah, and these stocks have moved a lot in a significant period of time, particularly, the fund launched in April 2nd, which was 2 days after the market bottomed. And the market has been, the market performance has really been driven by semiconductor names, especially the memory names. So the performance moves have been really historic and really significant in a short period of time. So I think that's, for me, worth acknowledging. So I agree on that point. Now, there's also concerns to your point about this being a bubble. Now, time will tell, right? We believe that we remain in the early innings of the generative AI build out. And so the bull case for this going forward is that the memory space is undergoing a long-term restructuring and a long-term re-rating of how investors price those underlying securities. And so what specifically do I mean by re-rating? It means by what basically price to earnings multiple do you assign to, and we'll use Micron as an example because they're a US company, for a company that historically has seen revenue that's really cyclical. So 2 terrific quarters followed by 2 pretty poor quarters, and then sort of a mismatch in the market for memory chips that then will impact what they can charge for those chips. The idea that Micron should trade at a structurally higher price to earnings multiple is predicated on the fact that their revenue model is undergoing a change. So even a few years ago, less than 15% of their revenue was tied to AI data centers. Today it's 65. So a bear could say, well, if that stops, well, then that would impact sort of that long-term, more structural contracts that are being written. But we do know that spending is occurring, and it's actually been projected to increase. The One Big Beautiful Bill, I think, helps with that. At some point, that will moderate. But at the same time, memory chips are chronically, right now, are undersupplied. So demand is outstripping supply markedly. The companies can charge higher for those memory chips. And the ability for them to put more supply on market is frankly a bit unavailable to them today. It takes 3 to 5 years to build a new fabrication facility. In fact, the most important tool that they need to, that what they would put in those facilities is actually sold out until 2027. So even if they had a factory that they were ready to open tomorrow, they wouldn't be able to fill it with the tools that they need to make these chips. So the bulls, the bull case for this to continue, and I think the stock prices are probably not going to be subject to the same sort of parabolic moves that we saw going forward, because we have seen this first stage of that re-rating is that, again, Micron and its peers, just using, again, that as the example, should no longer trade at a 6 PE or even the 10, 12, which has moved up today, but should be closer to a 20, more similar to other semiconductors. So DRAM trades at a significant discount from a valuation multiple compared to broader semiconductor indexes or even the broader technology space.
It was amazing just looking at the PE ratios of some of the companies that we've talked about here today, much lower than what people might otherwise expect. I guess on that note, before I let you go, how instructive can PEs be in this space? Because it does move so quickly. It is highly cyclical. You think about forward earnings guidance, and there's a lot baked in there. Again, the PEs, that's just one measure here. I'm just curious, how do you think about that in this space?
Yeah, I think ultimately these companies are going to continue to be rewarded for their revenue growth, which has been historic. And in fact, these companies are now projected to be some of the highest earning companies in the world, more than hyperscalers. And they're generating, doing so while investing in CapEx, but not nearly to the same extent that the knock on now some of the Magnificent Seven is that they're kind of overspending relative to where their cash flow is. So I think if these companies continue to put up really unprecedented revenue numbers, which we believe that they're in a position to do, then the market will kind of slowly going forward begin to re-rate them. We just got through an earnings season where that thesis for one quarter was validated, but that will need to continue to occur quarter after quarter for this to continue to play out relative to the expectations I think that the most bullish analysts have.
Well, Dave, excellent overview on this entire space. Congratulations on making ETF history. You are now forever in the industry's record book. So I always love seeing the success for you and certainly the entire Roundhill team. So congratulations on that. And thank you for joining me. That was Dave Mazza, CEO of Roundhill Investments. That'll do it for this very special edition of ETF Prime. As always, if you'd like to get in touch, you can find me on X at Nate Geraci, or you can go to etfprime.com. Thank you for joining.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova DS Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.